predicting $500 oil by the end of the decade. Late this decade, early next. Predicting $20,000 gold, $500 silver. Copper, who knows, could go to $20 or more from, I'm predicting $6 pre-bust. So this year, and then could go down as low as $1 in the bust and go from there to 20 or 25 in the big move, big commodity cycle. Natural gas will go through the roof, et cetera. So I think all commodities, including ag commodities, will be huge winners post-bust.
Gold prices fell by about 1% on Wednesday due to a stronger U.S. dollar. Investors await crucial inflation data from the U.S. to gauge the likelihood of a Federal Reserve interest rate cut in September. Spot gold dropped 0.9% to $2,502.38 per ounce, with a peak decline of 1.1% earlier. U.S. gold futures also fell by 0.6%, settling at $2,537.60. In contrast, silver extends its gains for the second consecutive day, trading around $29.50 per troy ounce during Friday's Asian hours. This metal benefits from a lower opportunity cost as expectations for a September U.S. Federal Reserve interest rate cut rise. Looking ahead, DavidHunter, a prominent contrarian financial analyst, forecasts a dramatic surge in commodity prices by the end of this decade. He predicts oil could reach $500 per barrel, gold may soar to $20,000 per ounce, silver could hit $500 per ounce, and copper might rise to $20 or more per pound. Hunter predicts that if the market peaks at $7,000 and drops 80%, it could fall to around $1,400. He expects a rebound that may triple or quadruple due to increased money supply, but believes the market will recover only to about $5,000 or $5,500, still below the $7,000 peaks. This outlook is especially pertinent given current financial indicators. The S&P 500 index stands at 5,648.40, reflecting a 1.01% increase, and nearing the level Hunter identifies as a potential recovery point. Despite recent record highs, stocks have undergone nearly 10% corrections in the U.S. and 5% pullbacks in Canada. Please tune in for our exploration of DavidHunter's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
If we do hit 7,000 and have an 80% bear market, that takes you down to 1,400. You could have a triple or quadruple out of the bottom because of all that money created. So a new cyclical bull market, but even that only takes you back, say, to 5,000 or 5,500. As opposed to 7,000 or whatever. So you're not going to see those highs again, in my opinion, that we reach later this year. I don't think we'll see those for decades because, you'll have a cyclical bull market because you're going to have all this money. You can have rates going to, down near zero initially and moving up gradually initially. But then inflation takes over and rates start moving up much more aggressively. When rates move up, PE multiples move down. It's an inverse relationship. So we had this secular bull market for the last 42 years, in large part because PE multiples went from single digits back in 1982 to 20 or 25 times market multiple now, or at the top, and we'll see the reverse of that in the second half of this decade, where market multiple will be getting squeezed and going lower as rates move up. And so that's going to keep the indexes from being able to move ahead. They'll, like I said, they'll have a couple of years or at least a year or two where you still have rates relatively low, you still have inflation relatively low, and you have a lot of money being put to work. But then by say later 2026 and then beyond, your rates are going to be moving up more aggressively, and that's going to squeeze multiples. There will be parts of the market that will benefit from inflation. Commodities, it will be a commodity super cycle. Commodities will go through the roof. I'm predicting $500 oil by the end of the decade, late this decade, early next. Predicting $20,000 gold, $20,000 gold, $500 silver, Copper, who knows, could go to $20 or more from, I'm predicting $6 pre-bust. So this year, it could go down as low as $1 in the bust and go from there to 20 or 25 in the big move, big commodity cycle. Natural gas will go through the roof, et cetera. So I think all commodities, including ag commodities, will be huge winners post bust because of all that money. What happens is you're going to create all this demand across the board because you've printed all this money, and commodities don't have the infrastructure. We've been rationalizing down our commodity capacity for decades. So all of a sudden you blow up demand. You can't create supply that quickly. Supply, you have to create new mines. You have to, create new refineries, et cetera. You're just not going to be able to meet the demand. And the only thing that can give when demand far outstrips supply is price, and price will go through the roof. So that sector of the market will do well. Commodity producers will do well. But those that are passively invested in S&P indexes or any of the broad indexes are going to find that they're lagging by a long shot, that they can't keep up with inflation because their indexes are either going down or not going up any.
Hunter's forecast is in line with the current market trends. He anticipates that treasuries will perform well next year and predicts the dollar index will fall to 80 in the next 6 to 8 months. However, he expects the dollar to rise to 120 or higher during the later stages of the economic downturn. This outlook aligns with recent market movements. The dollar has recently strengthened to a 2-week high as traders await the crucial U.S. jobs report, which will impact the Federal Reserve's decision on rate cuts. Simultaneously, U.S. Treasury yields have reached mid-August highs, supporting the dollar and decreasing the chances of a 50 basis point rate cut by the Fed. Adding another layer to this analysis, Peter Schiff, CEO of Euro-Pacific Capital, suggests that the U.S. dollar's weakening may persist until 2025. He foresees this could lead to a significant economic crash and a subsequent sharp rise in interest rates. Schiff's perspective complements Hunter's forecast and provides a broader context to the current financial indicators and predictions, reflecting the intricate dynamics between currency strength, economic policies, and market expectations. Let's get back to the video.
I will just say that I think next year the treasuries are going to be the one thing that will hold up in the market. We didn't talk about the dollar, but I'm calling for the dollar down, DXY down to 80 in the next 6 or 8 months. And then during the latter half of the bust, I think the dollar becomes the flight safety trade, and you could see it go all the way back to 120 or higher. But I think that's the last hurrah for the dollar, because I think the story beyond that, with all the money created, et cetera, you could see a dollar down to 50 by the end of the decade. So, but I think the dollar short term is going down, and then will be something that will hold up once you get down to 80 in the bust. But treasuries, on the other hand, I think you could see 2.5% this year in the 10-year, and I think you could see 0 at the bottom of the bust, because they're going to be buying up every treasury bond when they do QE, right? So there'll be plenty of demand from the Fed as well as other places. And I think short rates will probably go negative during the bust. So treasuries will be one of the places you can hide, I think, during the bust. There won't be very, very many other places. I don't worry about FDIC insured savings. I think they will provide, because of the printing press, they can provide whatever money is needed for the FDIC to meet liability. So I think as long as you're within the $250,000 threshold, I think your savings will be safe. And frankly, last cycle in 2008-9, we had the don't break the buck policy with money markets. So they basically backstopped the money markets. My guess is when they're printing money, they're going to do whatever they can to backstop money markets and bail out pension funds and things, but they're not givens. Those are, I can speculate on that, but those at this point are not givens. Treasuries are pretty much a given because it's government guaranteed. It's not implicit, it's stated. So I just want people to know there are going to be places to hide. Not very many, though. And you really, if you don't protect your capital and you lose it, there's going to be, you're going to have a harder time getting prepared for the 2030s. So I think it's important to don't get crazy, and it's going to, as I've said, people are still pretty skeptical about this market. At the top, I can predict, given my years of watching sentiment, at the top, you're going to have everybody all in. There's going to be a compelling story that the Fed's aggressively easing and that there's a long cycle ahead. I don't think there is. Obviously, I'm calling for a bust next year, but that's going to be the narrative at the top. And you've got to resist that if you're going to avoid, the trap, because obviously that's how sentiment works. At the top, everybody's all in. At the bottom, nobody wants it. So you've got to reverse that. That's what contrarian means, is you've got to be able to fight the crowd.
Gold is projected to reach $20,000 per ounce by the end of the decade, and silver could rise to $500 per ounce. At the same time, forecasts indicate that the USD to INR exchange rate may strengthen to 100 by 2030. These anticipated changes highlight significant potential shifts in commodity prices and currency values, driven by broader economic trends and market dynamics. What are your thoughts on the future of gold, silver, and currency exchange rates? Share your insights in the comments below. If you found this video informative, please give it a thumbs up and subscribe to our channel for more updates on market trends and forecasts. Thank you for watching. Stay informed. We look forward to seeing you in the following video.